Good day, everyone. I'm Todd from First Bank's Wealth Management Group. I'm recording this video on November 1st, and all that I can say is thank goodness October is over. What a tough month for the markets. October will go down as the worst month for stocks since 2011. The S&P was down 7% for the month. All major indexes were in or near correction territory. FANG stocks, I'm talking about Facebook, Amazon, Apple, Netflix, and Google, were bitten. Collectively, those stocks were down 19% for the month. How did this happen? The markets were looking really good in September. I can think of three likely suspects: rising interest rates, midterm election uncertainty, and continued trade war worries with China. You may remember that I mentioned this as a potential risk to the markets this summer. I said that conventional wisdom was that we would avoid a trade war. But we all know conventional wisdom is often wrong. So today I want to address these three suspects one at a time. First, rising interest rates. Yes, it's true that interest rates are rising. The Fed has raised rates 3 times so far this year, and we think we get a fourth increase in December. So the Fed funds rate sits at 2.25% today and will be 2.5% at the end of the year. Any number under 3% is considered stimulative. 3 to 4% is a range considered neutral, and you really need to be over 4 to be considered tight. Even if we were to get 4 rate increases next year, which the market is not anticipating, we would still be in a neutral rate environment. You can also look at the 10-year Treasury yield, which is around 3.1% today. The 25-year average for the 10-year is 4.4%, and the 50-year average is 6.5%. Hey, the point is, we don't see high interest rates killing the market in 2019. Second, midterm elections. Now, by the time most of you watch this, the midterm elections may be over. As I record this, they are just 5 days away. The market's fear is that a big win by the Democrats will undo tax reform and roll back regulatory reforms, both of which have been really good for stocks. Now, obviously, I don't know the election outcome, but to undo the tax cuts as well as regulatory reform, the Dems would need to win a veto-proof majority in both houses of Congress. We don't think that's going to happen. Third, and the one that concerns us the most, is trade wars. Now, here's what we know. Europe has agreed to some concessions on tariffs and have at least stated to work together with the U.S. towards zero tariffs. We went head-to-head with Mexico and Canada earlier this year, and we ended up with pretty positive outcomes on new trade agreements. China is still in the early innings of negotiations, and it's too close to call an eventual outcome. But on the positive front, China has cut some tariffs on U.S. products, including machinery, electrical equipment, and textiles. The overall level of tariffs went from 9.8% to 7.5%. So we know that China is willing to move and make some changes. This is a start. On the negative front, the U.S. tariffs already in place on China, which are 10% on $200 billion of Chinese imports, are already impacting American companies such as Caterpillar, PPG, Sherwin-Williams, and other industrial companies. This 10% goes to 25% in January. If we don't get closer to a resolution as we approach January, we could see more market sell-offs. We remain sanguine that a trade deal with China can get done, and we will avoid an all-out trade war. We know that their economy and their stock market are in tough shape, and putting all this behind us is in both countries' best interests. The market can resume its upward trajectory if we can positively resolve the China trade issues. We don't think that increased interest rates and the midterms mean doom for the markets anytime soon. Sell-offs are a buying opportunity for long-term investors. Buy low, and sell high, and stay invested. Thanks for watching, and if you have questions, comments, or ideas for future topics, email me at gene.todd@fbol.com. See you next time.